So today I'm delighted to welcome Kevin MacSweeny. Kevin is Head of Managed Equity at Quintus Capital Limited, which is, I suppose, a private equity firm, Kevin. Would that be broadly right?
It would be. Quintus Capital is a boutique private market investment firm. So not just an equity. It's got a number of different pillars. It's got the EIIS fund, which we were talking about earlier, and we have the managed equity pillar, which is private equity, so, and you've also got private credit.
Okay, so. Before we get into the private or the managed equity part of which I know is your focus, when we were chatting before we started to record, you were kind enough to give me a brief potted history of yourself. Could you do that for our listeners, please?
I certainly can. And firstly, thanks for having me, Paul. Delighted to be here. So I'm a Cork man, permanently seconded to Dublin, married to a Dublin ladies and 3 young kids. So not going back to the motherland. My background was family business. Growing up, I was always working in our family business, which was retail, with my father. And we grew that business when I was in, I suppose, school and college, which was a great grounding. I think retail in general is a great grounding for anyone, not just about business, but also how you deal with people, how you treat people. You're getting every type of person walking in off the street, whether it be a lawyer, a banker, to a cleaner of an office. So never a dull day. But my background was economics and finance. So I moved to Dublin, where my first professional role was actually in a business called Noonan Services after leaving finance. And that was a large services business in contract cleaning and security. It was a facility services business where I joined Pete Smith, who I spent a long time with after. He was CEO of the business, and the business was owned by the Noonan family, started by a gentleman called Noel Noonan, phenomenal entrepreneur himself. And I suppose with a couple of acquisitions along that journey, Pete and the family sold the business to UK private equity, and Broadlake was born. So Broadlake was a business started by Pete Smith after exiting Noonan, that was set up essentially initially as a family office, investing capital, and I suppose that's where I was employee number one, and it was a really interesting time. The business was sold mid-2008, so timing was good. You could call it knife-edge stuff, really. And I suppose Broadlake was formed in 2009, which on paper sounds great when you've a capital-constrained market and the world had completely turned. But there was no triggers for anyone to do anything. So the market was actually very quiet. And I suppose, as a part of Broadlake, I was involved in the investment side for 15 years in Broadlake, and we invested in 7 what you call
buying businesses and selling those businesses.
Yes, so investing mainly in businesses. So rather than buying, and there's a big distinction in the sense of, our model was minimum investing to take a 30% stake in a business, up to majority. Some businesses we'd up to 70-75%, but typically, in the kind of 30 to close to 50, slightly north of stake. So you're a significant shareholder of which you have to be able to add value, and I think that's the key point. And it's not just when it comes to investing or even on both sides, investing the capital or taking capital from private equity or any other source of capital. capital is a commodity. It is the commodity. And you always have to ask yourself, what else outside of the capital am I getting, particularly when it comes to equity in your business? And I think that's something that we really, really focused on in Broadlake, and now is a real focus in Quintus.
And so originally the Noonan business you mentioned, and then Broadlake. What would I be right in saying what you're effectively doing is helping people with capital to invest, to diversify that capital across different businesses, different models?
We are now, yes, in Quintus, and I think it's good. It's a good point you make around Broadlake. Broadlake was captive capital in one sense. It was family capital. It was Pete Smith's capital, and as the business evolved, it was, very good friends of mine, Pete Smith and Brian Crowley's capital, both. And I suppose so. We didn't take external capital, and that was an important point. And we were investing that capital into strong businesses. And I suppose the difference in if you want to call it asset class, generally in equity, you've got, you have angel investing, you've got at the almost pre-revenue stage, you've got VC investing, which is earlier stage businesses or technology enabled businesses that is more venture. And then you come into the private equity space they're profitable businesses. So often it's funny, it's a bit of a dichotomy. Like, these businesses actually don't need money, and I think that's what I love to talk about. Is I love to talk about businesses that have options that don't need your money, because then it is not about the money. It's actually about what you can do for them along a journey, whether that's invest alongside them for 3 years, 5 years, or even a bit longer. As long as everyone's aligned and you're investing a good stake, you have to be able to add value along a journey.
Yeah, and you were saying to me again before we started recording, I think you said to me two things: how equity release can create wealth now. And you also said, which seems to be somewhat opposed to that, how staying the course can deliver bigger returns. Can you expand on those two things a little bit for me?
Yeah, and I think, with my background, it was probably one of the things we did exceptionally, I like to think exceptionally well in Broadlake, and not just us in Broadlake, but other private equity in Ireland do well, is in investing at a point that releases equity for entrepreneurs. And sometimes what I have seen, and in businesses that we have invested in, some we've exited very successfully, which is great, and some that even as a part of Broadlake we had held on to for the right reasons, because they were growing. Equity release is something that, if an entrepreneur is thinking about, is definitely worth exploring, because often, I have a couple of examples without names, is you've got businesses that are generating even in certain brackets of $1.5 million to sometimes 2.5 to 3 million of profit, but the founder or entrepreneur actually isn't taking a huge amount of that money out. Now, sometimes they're putting money into pensions, etc., but they haven't taken any equity release to kind of look after what people like to call home.
Yeah.
So it's like look after home, or put money in a holding company, or do whatever. And often what I've found too, through 3 instances, but 2 in particular, one business that we sold and one business that is now 4 businesses, that is the healthcare group in Broadlake, that is literally 5 times the size it was since we've invested. Is it can often change how someone looks at their business when you release some equity, when you look after home. You could be an entrepreneur that takes 3, 4, 5 million euros off the table, but bring in a partner that's aligned with you along a journey, and that's important, that they can add value along that journey. But that equity release can actually change how you look at your business, because you can sometimes, and I even see it now in 1 or 2 things that we're looking at in Quintus, is is you're always looking at risk. Like we're looking at risk, but entrepreneurs are always looking at risk. And often opportunity can be risk.
Yeah.
And you might not be willing to take certain opportunities because it comes with certain risk of capital, risk of equity, risk of, it not working out due to maybe a lack of depth in your team or structure in your team, etc. And I think that's where we really added a lot of value.
Yeah.
Was helping people take some equity off the table, maybe look after home as I've said, but actually give them the opportunity to look at their business differently. Because I think, again, if you look at, funnily enough, one of the biggest things you can do for an entrepreneur of a scaling business to a certain point is actually for them to realize that they might not be the CEO of the business. Going forward, they should not shy away from that. They should consider that, because entrepreneurs often get things to a certain point, and at that point, it might need different management,
different skill set.
But equally, it allows them to work, and this is really important to hammer home. It allows them to work on the business, not in the business. And that is really, really important, because they've got the business to a certain point for a reason, because they're the entrepreneur. They spot opportunities. Professional management do not see opportunities the same way the founders do.
Yeah, it's interesting what you say there. I've often said to people, we talk about, you mentioned home, so we'll talk about the home, and the home is, twice as valuable as it was the day you bought it. But I often say to them, but it's not in your pocket. It doesn't matter what it's worth today until you release the equity. It's all on paper. And so, in terms of businesses, looking at that, and, as you say too, I remember years ago a sales trainer saying to me, there's two different skill sets, one to dig the hole and one to keep the hole dug.
Yeah.
And the problem is that the fellas who dig the holes very well get stuck into keeping the hole dug.
Yeah.
Whereas if they brought somebody in to keep that hole, they could dig another hole and another hole. And I think that's kind of what you're saying here, that the equity release for entrepreneurs with valuable businesses. The other thing about, replacing yourself as CEO, years ago I had a business where I did exactly that. And I did it because I came to the conclusion that the skill set needed to grow the business from that point onwards was a different skill set than I possessed. And I think that's what you're saying there, isn't it?
Absolutely what I'm saying. And it takes a certain, I think it takes a certain awareness too. You have to be self-aware. And I think, in fairness,
get the ego out of the way.
The ego is the biggest issue.
Yeah.
Ego is not an issue, but everyone has an ego.
Yeah.
We all have an ego,
Absolutely.
right? But it's just how you manage.
It's part of humanity.
It's how you manage that, right?
Yeah.
But it's, and again, very good friend of mine, Brian Crowley, and obviously Pete Smith, both of those guys are entrepreneurs themselves. But Brian built a business called TTM. And, within that business, he had dug a phenomenal hole. Let's use that analogy, and was continuing to make that a phenomenal success. And hold as a bad example. So let's say build a building, the foundations for a great building, and he had taken it from below ground, the foundations, right up to 5 floors. Big building, big business. But within that, he started to build another next door, but in the same site, if that makes sense. So he was the entrepreneur growing businesses within a business because he could spot opportunities. And I suppose where Pete in particular, and we support, helped support Brian on his journey, was allowing Brian to see that, him working on those opportunities and on those businesses and bringing, often promoting people within the businesses, but treating them like separate businesses and separating them out. That's where those people and the entrepreneurs will add most value. Yes. Because there's no stopping them looking at another building and growing that one.
To 5
but then all of a sudden you look at the old site and your existing building that was 5 floors is now 15, 20 floors. And I'm using that as an example, but that is literally where his business went.
Okay,
and
so-
then you've got 2 other businesses that are now above 5 floors.
Yes.
Without his hands on them.
Utilising the entrepreneur's skill set for
Exactly.
what he or she is best at.
Exactly.
Yeah.
Exactly.
I often say it's like, you don't play Messi in goals.
Yeah.
You know, what use is he?
But you know, that's the funny, in goals, right? And it's something that I always say to people, and often some people can kind of look down on accountants and finance people as bean counters, right? I'm not an accountant, so I'm not an accountant by trade. They're so important to your business.
Yeah.
A good finance person is not just someone that looks after the finance of your business. A good finance function in your business can actually not just be a defensive role, but can be one of the biggest offensive things in your arsenal when you're looking to grow your business.
Yeah.
Because they can start to help you with operational decisions, management decisions, even how you would look at new opportunities. So just purely because you said the word defense, or the goalkeeper, and often people just do see them as the goalkeeper in the business. I see the complete opposite. Like they not only take over defense, but they can release your strikers, because and that is really important, and for people to understand is the power of a good finance function in your business can really help scale your business.
Yeah.
And allow them to support your business, because it's such a crucial
Because I mean,
part.
in a way, you're saying business is a team sport. You know, and I couldn't agree more. I mean, if I can continue the Messi analogy, my son, who's a Liverpool supporter, was very happy this week because of the win. But when he was a bit younger, I remember we were talking about Messi, and I was saying, if Messi played Chesterfield United, who'd win? And he said, Messi. And I said, no, think about it for a second. He may be the greatest footballer that ever existed, but football's played by 11 blokes, not one. And then he thought, well, he said Chesterfield United had beat him hands down, because it's not about just having the greatest player that's ever existed, but it's having the other 10 around him, isn't it?
Yeah, but as well, it's about having the wide. Again, let's stick to it because it's interesting, right? Because it's funny. My son, or 2 sons, they listen to this thing called the Yoto, right? And they have stories. So they have the Messi story, and it's actually really interesting, because I lying down with them at night, reading them bedtime stories, and then turn on the Yoto, and you'll hang around for a while, obviously, to get them to sleep, right? Yeah. But it's really interesting when you hear them narrate about the backroom staff and the support staff. That's what private equity and equity can bring you.
Yes.
Is that support. They're your coach. They're your support staff. They're your backroom staff.
Yeah.
They allow the players play on the pitch.
Yeah.
They never play on the pitch.
No.
But that's what brings success.
Yeah.
So, and I think that's important when you are the Messi, or you are even building the team. You're not building a team around a Messi, because when Messi goes, when the entrepreneur goes, you
need to be able to continue to win.
Yeah,
the league.
but it's got to have a system. It's got to have a function. It's got to have process. It's got to have, every team has a process, and I think that is really important for businesses, and something we focused heavily on in Broadlake and are focusing on in Quintus, is how you can help support that. It's growth structure. It's how you structure your business for growth, and that's foundational stuff.
Okay, so Quintus Capital is a business that's raising funds to invest or in these other businesses, if you like, and you're raising funds from independent clients, I suppose.
Sure.
Are your investors predominantly companies, holding companies, individuals? Is it across that spectrum?
So just as I suppose step back slightly, right? I suppose I left Broadlake after 15 years, so I released equity, and that was important, and look, still Pete and Brian still very close friends, as well as I owe them a lot, and I worked hard for them, and that's important to me, and that relationships continues to be important to me. So I learned a lot, and I suppose what I did was, when I exited, I was looking for a platform, to invest my own
So
capital.
you, in effect, in this part of your story, are the entrepreneur with the equity release.
Yes, and I
And now
suppose
looking for something to do with your money.
Well, I wouldn't say that, but it's look. I came in and I took an equity stake in Quintus Capital, and then a partner of mine, Fawad Khan, followed. So we took a significant stake in Quintus Capital, but they already have phenomenal shareholders and structure, which is important, right? Because it was an existing business. It was a business that had already raised capital for EWS funds as well as some private credit deals, so it had structure, it had people, and business that was formed was basically born outside of an accountancy practice. So again, I like that. I like when something has kind of come from has a background, has a heritage, because you had people like Tim McCarthy and Quintus, Paul O'Connell, Fakhna Omani, Dave O'Brien, and these guys have been advising their clients for a number of years, and these clients really trust them. And now these clients aren't just individuals. They're family offices, they're companies, some of them are almost mini institutions themselves. So taking the equity stake myself personally in Quintus was important because, when you say about raising capital, so we are not a fund and we won't be a fund, and that's important. So we're not raising money to be a part of a fund. We will only raise equity when it's
when you have a specific project.
When it's a specific project, when we're investing. So we're working on 3 at the moment where we're raising. And back to your point as to who are the investors, it is a mix, right? Because look, I've been in the market / equity for over 15 years. I have a lot of good friends. I have a lot of good connections or contacts. Connections, cannot contacts really. Some friends, but often some deals will have a level of an institution involved. So as an example, pick an example. Let's say we're doing a 10 million investment in a company, taking a significant enough stake. Typically, 5 million of that might be an institution that will be a contact of mine. They're backing us, they're backing our model. And then the other 5, again, I'm just using an example, will be made up of high net worth individuals and family offices predominantly. That would be in our network. And the way we would invest is the minimum investment from an individual or a family office is 500,000 euros. So it is for sophisticated investors and high net worth. It's not for others outside of that, and that's important because,
or if I can, it's for well-off investors.
Yes,
Sophistication might give people the impression they have to know what they're doing, but
True.
Buying you, Kevin. You're the one who knows what they're doing.
Yeah,
we hope.
Yeah, well, yeah, exactly. And I think trust is important, and I take my responsibility very seriously because each of these deals on the managed equity side of our business, I am personally cornerstoning myself. Yeah. So I am putting my own capital into these deals.
That's what I was going to ask you. Do you have skin in this game?
Absolutely. And you do. Often too much, but it's a case of that's also why the institutions that come in alongside us.
Yeah, so you're not asking institutions or individuals to invest in something you're not willing to back yourself.
Not. Okay, and that will never happen in Quintus Capital on any of our managed equity deals.
Good.
It will not happen.
And then explain to us, will you, the ideal target for you. I presume you have a bunch of benchmarks you use to identify potential investments. Tell us about that. What?
Yeah, so if you look at the companies we're talking to at the moment, or people, or even businesses we would consider talking to, or where it's appropriate, and that's not about that we would consider, it's where it's appropriate, or we would always defer people elsewhere if they were either too big or too small or on a different journey or looking for something different, is typically the businesses we would look at they're often founder-led. So they're, it's where you've got a really good entrepreneur, and that's why I'm not starting with numbers first, because this is so important.
Yeah.
An ambitious and open entrepreneur that actually is getting to a point where their business is, in in the 1.5 million to 2.5 million of profit space, right? Because, if you're a million or sub a million of profit, that's not our space.
Yeah.
It's just.
So you're investing in already successful businesses,
Yes.
first of all.
Yeah.
Okay.
And that is important, because it's important on both sides, because that's really where I can add where we as a team can add the most value. Earlier stage businesses, I cannot add that much value. So it's where a business has gotten to a certain point, let's say, 10 million in revenue, 5 to 10 million in revenue or above.
1.5 to 3 million in
call
profit.
it and look
or more.
to double, if not treble that along a journey, double at minimum and treble,
That was my next question to you. So you found the business.
Yep.
You've done your due diligence, which has identified the business as investable,
Yep.
if you like. The asset test is you're prepared to put your own money into this
Yep.
opportunity. So what are your plans then? What does good look like from an outcome point of view?
So you've touched on a really important point before we come to the outcome, right? Because the outcome I'll talk about in a sec is the process, the investment process. And that's why I invested in a platform.
Yeah.
And that's why I believe individuals and family offices should invest through a platform.
Okay.
And the reason for that is governance. The reason for that is investment committee, and the reason for that is due diligence.
Yes.
And I cannot stress enough the importance of that, because there's accountability. I can't personally, Kevin MacSweeny, identify a deal, decide it's a good idea and run with it. We have to go through full financial due diligence, tax due diligence, legal due diligence, as well as legals, sometimes tech due diligence. So that's all a part of the process. It has to go through 2 stages of internal investment committee in Quintus, and that is very important. So I cannot go on solo runs, and no one else can. And as an investor, I take comfort from that, right? And anyone else's capital, again, I made that point earlier, that I take that very seriously. I do. I take that very seriously, and that's why it goes through that process. Because no matter what happens along the journey, that once the investment is made, that it has gone through a process. That it's not me convincing people that this is a good or a bad idea.
Yeah.
And that is important. It's back to that whole point earlier about Messi and the team. The team is so important, but so is the process.
Yes.
And it's the same in business. You have to have a process, and you have to have
It's the
accountability.
training is more important. I mean, good to use the football analogy.
Yeah, but accountability and responsibility is so important, because in this space and in this sector, that is super important. When you're investing other people's money, they're trusting you with that money.
Yeah.
And you have a responsibility with that money, not just their money, but often it's the family money. And when I was referencing home earlier, I'm not actually obviously talking about a house. I'm talking about the family
You're
wealth.
talking about the family
and that
jewels.
is yeah, but that's it is very important. Now, and then I suppose to your other point of the outcome is, look, you're going into these businesses and you're forming a plan, a 3 to 5 year plan, and that is important, right? And often what I say to people is, you have a 3-year plan and you have a 5 to 10 year vision, right? Because it's very hard for you to plan for 5 years.
Yeah.
But you can plan to 3 years, and you can build your blocks, and there's a full process for that. But it's funny that once you kind of get to building the blocks for 3 years, 5 years becomes a bit more obvious. And you can start to see
it comes into focus.
It comes into focus. And I think, look, what's really important is the equity support being us, but equally the founders to be able to see that. And you can show them to say, look, at a certain point, potentially, not always the case, potentially you should be working closer with us on this plan/vision for the 5 to 10 years. Because if you're, as an example, if we come in and take a 40-50% stake in a business, and there's a 5-year journey, and you've got the entrepreneurs, that's also potentially that person's 5-year journey. But if you don't plan to make yourself redundant in the business, You're a part of the other journey after the sale.
Yeah.
So that is equally important because it's succession planning within the business. And
Yeah,
that
it's to
is
allow you free yourself
to exit.
without
That you're not day to day
without
in the business.
without that affecting the value of the
And
entity.
often quite the opposite,
Yeah.
increasing the value of the business.
Yeah.
Because it's not reliant on one person and it's not reliant on it.
Just, I mean, we won't hold you to anything here, Kevin, but go back to the outcome. So if I'm an investor in one of these projects,
Yep.
you know, and I know the projects are different. So there'll be different outcomes for different projects, I presume, or certainly different predictions as to outcome. But broadly, I'll use the phrase, what does good look like? What do you see as an investor, never mind the manager of this process and the fund? What do you see as a good outcome over 5 years, or if that's the right term?
Yeah, so an outcome is something that you dictate yourself by planning, right? So an outcome just doesn't happen, right? And I think that's really important. So when it comes to investing, there's two drivers of the value of a business, right? There's the valuation driver, which is the multiple driver. So as an example there, just to break it down, is let's say you have a business making 2 million of profit. And let's say we come in, and I'm only using it as an example, we might value your business at 5 to 6 times your profit. It's generating 2 million of profit. It's a good business. It's of a certain scale. And we're taking a 40 to 50% stake in your business. So now in the two indicators I'm giving you there is the profit number, which is 2. And I'm also giving you the value.
4 to 5.
Or
Whatever, or whatever.
5 to 6, or whatever way you want to look at that, right? Along the journey, you can dictate both. So the one obviously you have the most control over is your profitability, because you have the operational gearing of your business, you have the structure of your business, you have the growth opportunity which you're investing in your business. So let's say you take that business within 3 to 4 years to 5 million of profit, as an example, which would be, fairly I wouldn't say typical, but that's the minimum of what you would aim for. In the 5 million of profit bracket, you're now in a much different buyer pool. Your business is structured differently. You've got a wider structure in your business. And that is equally as important. So sometimes your business may have made an acquisition along that journey. So something that we can add a lot of value to, and as a part of a growth journey is something definitely to look at in your toolbox of growth. But you haven't just grown your bottom line, which is your profit number, call it EBITDA without going too scientific, but you've driven the bottom line. But now you're attracting a different buyer pool that attracts a different valuation pool or multiple pool.
Oh, okay. So if I can put that into English I can understand. Let's say, and I'll make the arithmetic real easy for myself, you're investing in a business with a 2.5 million turnover, or profit, beg your pardon, the day you make the investment.
Yep.
And it's valued, we'll say, again, to make the arithmetic easy, at 4 times that day. So it's a 10 million business. Over this investment period, you raise the profit to 5 million. But that doesn't mean that the value has gone up to 20 million. You're saying you're moving up the multiple scale by having a bigger business in that regard. Yes?
Absolutely.
So you've not only potentially doubled the value through 2.5 to 5 million, but you've actually more than doubled the value, because at 5 million you're in the 7 times, 8 times, as opposed to 4 times.
We call it the attractiveness metric, because you're actually driving value.
The more beautiful you are, the more valuable you are.
It's not just down to a profit number. It's about how the business is actually geared for further growth.
Sure.
And that's really important.
Because that's what somebody is buying, isn't it?
Exactly.
If you're buying a business, you're buying the future, not the past.
Exactly. So, and that's what that is super important on the way out. And, we had a few really good examples of that in Broad Lake, and, we'll also in Quintus. But, there's a good example in Broad Lake where we invested in a business, and not too dissimilar to what you were saying. And, they had an offer on the business. a good offer at the time for the business. We invested, took a stake, were involved for just shy of 4 years, but sold the business for probably 3 times
The offer.
the offer.
The original offer. Wow.
Yeah.
And
And
I
sorry,
mean, it's
that is not just all us, by the way.
No.
That was a really good entrepreneur, really good management team.
Yeah, it was teamwork.
It's teamwork, the support,
Yeah.
how you structure a business, but equally how you position a business for
Well,
sale.
It has to be more than capital then, Kevin.
Capital's a commodity.
What else is Quintus bringing to the table there in terms of achieving these outcomes? What else, other than the capital, what else is it bringing to the table?
It's back to that word I mentioned earlier about structuring and structuring of the team, because what's important is when you structure a business correctly and you put the right pillars in place, which is important to have people in roles that look after finance, that will be head of sales, that will be head of operations, depending on the setup of your business. But that there's the right structure in place, that they've got the right reporting structures up with KPIs to make sure you're informed, and even initially as the CEO/founder.
Right.
It puts a process, it puts structure in place that allows, you see, businesses often are very focused on outputs and often not focused on the inputs that achieve those outputs. Your KPIs should actually be your inputs, not your outputs. And if you look at it that way, you kind of go, what activities does that pillar or does that need to do to achieve a certain number? And then you backfill the KPIs as an example, just minutia, but it is important to think of it that way, because if you can make it as clear as possible to even senior people within your business, doesn't matter about what scale the business is, as to what they need to deliver and how they need to deliver it in any given year. It makes what could be seen as stretched budgets a lot more achievable.
Yeah.
And what that does over a period is it then allows someone to step out of the business and to start thinking a couple of years ahead, because you now have a process and a structure to show people the in-year. But if you're the entrepreneur, you don't want to be living in the in-year, because you're now looking at the multi-year, what you call the multi-year opportunities. That could be an opportunity for 2 years' time, 18 months' time. But if you're not looking at those...
Yeah, because you're too busy working in the business.
And it's back to that point of being in versus out. And it is looking at it that way, help structure the business for growth in that way. It sets the platform up to be able to take opportunity, but equally to actually start to look at buying other businesses.
So you're bringing not only capital, but expertise in these areas. You again, what you said there reminds me of something years ago when I was first involved in managing people. A fella with much more experience than me reminded me that all I could do was manage activity. Couldn't manage results, but it's the activity that leads to the results. So in that way, I'm hearing what you're saying. You're bringing not only capital to the business, but perhaps new processes to manage and structures to manage activity.
But with the entrepreneur and the founder, and that's really important.
So you're in partnership with these entrepreneurs.
I would never step into a business and say, this is how you're going to do business.
Yeah. No, and that planning is done, I suppose, before you come to me looking for capital. That job has been done.
Absolutely.
Yeah. So
a
business plan is in place.
The business plan is in place.
Actions agreed.
The good old Mike Tyson saying is like, everyone's got a plan that they get punched in the face. But I think every business, like, plans are really important.
Yeah.
But you also need to be aware of when a plan needs to change.
And you need a good personal relationship then, by the sounds of it, with the entrepreneur. And that leads me on to another question. And you and I talked about this before the tape was rolling, but when you're in this process, Kevin, who are you representing? Because if you think about the way you've described the there's two parties involved in this process. There's the party whose equity is being released by you taking a stake in the business. and then there's the party who's facilitating that equity release with their capital. So which one of those parties is Kevin's client, as it were?
Absolutely on the investor side. So when it comes to someone looking to release equity in their company, they should have an advisor, right? And that is super important, because at Quintus, we don't advise companies. We don't advise people looking to sell their companies. We don't advise them. There's such a critical role in a good corporate finance and even legal, but particularly a good corporate finance advisor if you're looking for anyone to sell your business, for equity release, to raise capital. A good corporate finance advisor is so important and plays such a vital role, because that is not us. The investor can never be the advisor, because
there'd be a conflict, wouldn't there?
Absolutely. So, I would always what's really important is I represent the investors, of which I am one.
Yes.
But my duty is to the investors. Now, obviously, building a relationship with the founder and the company
is
hugely
of the
important.
Process, yeah.
But at the end of the day, my duty is with the investors, and that includes myself.
So how do the entrepreneurs looking for the equity release, how do they find you? Do they come to you rather than you go to them? Is it a bit of both?
It's a bit of both. But often it's funny how things happen. Sometimes it could be a chat. There was one business that we invested in that started on the side of a kids rugby pitch. So you just don't know where these things happen. But none of those investments were made without
the process
and
the due diligence.
The due diligence, but also that person engaging with an advisor and having an advisor, and that is really important, because the investor should never be the advisor, because obviously, as you said, it creates that. But also, in fairness, a good advisor will manage the relationship, because you're both acting as if you want to call it, pre-marriage or pre-investment. You need the priest in the middle to kind of make sure that what's being said on one side is being interpreted the right way on the other side. Because as you mentioned earlier, when you talk about breaking things down simply, often things do get very complex, and they do get very complex, particularly when it comes to legal agreements. And you should always have good advisors on your side when it comes to that, to at least explain the sentiment behind the commercial points being made by the investor.
So you're very clear with the equity releaser, let's say, the person who has the existing 1.5 to 3 million quid profitable business. Even if they arrive to you without an advisor at their side, you're very clear with them and saying, look, we represent the investors. Go away and get yourself an advisor to represent you.
Yep, okay, absolutely.
Very good. That is a good segue into the next question I wanted to ask you, which is about, you mentioned earlier about taking a minimum 30% equity stake.
Yep.
And just to talk about that, between that and 49%, you're obviously taking a minority stake in a private business, in essence. So how do you protect yourself? I mean, regular listeners will know I've often said a minority stake in a private business is worth what the majority stakeholder says it's worth, as the only potential buyer. How do you square that circle, as it were?
Yeah, so there's a couple of things. One being, look, you're coming in, you have to align yourself with the other shareholder, whether that be the existing shareholder or incoming shareholder, whatever it is. Let's assume it's the existing shareholder. There has to be full alignment, right? Because you have to be very clear that you're coming in to invest for a period. Be very clear as to what that period looks like, how long that journey is. Now, look, there's often variances in that for right or other reasons, but at least that has to be made clear out front, right? Secondly is that the relationship as to how it works along the journey is important. So the expectation on the investor as well as the company and the remaining shareholder is, what does reporting look like? What does the relationship look like? Where does Quintus get involved? Where they don't get involved? And that is really important because it dispels any ambiguity as to think, are they coming in? Are they going to start to make decisions on day-to-day running? And there's absolutely no interest. But when it comes to the strategic side of things or important capital investment projects along the growth journey, absolutely. That's where they should. That's where Quintus, where we should be involved. But having those ground rules day one is really important. And look, there is fundamentally very important, legal implications when it comes to the shareholders agreement. There has to be protections. There's legal protections for the investor. There has to be, because at the end of the day, the investor never has operational control of the business, and the investor doesn't want,
even with a majority stake in that example,
doesn't want
operational control.
I don't want to jump in.
You're
and
not
try and
trying to
run
manage these businesses.
No, and should never want to be, right? Because it's an investor is there to help support the growth of a business, not to run a business. Because you'd be kind of, chewing what you preach if you were saying, oh, we'll help you work on your business rather than in. But then you see Kevin sitting behind the desk, behind the finance guy. He's like, there's something wrong here.
Yeah, exactly.
But I think having a robust shareholders agreement is really important. But at the end of the day, Paul, if you're waiving a shareholders agreement in front of each other,
something's gone wrong.
Something's gone wrong. So the relationship is wrong.
But there is restrictions on it. I mean, the reason I say a minority stake is worth what the majority stakeholder says it's worth is once you have that, you have an ability to affect profit, for example, simply by declaring yourself a bigger salary.
Which they obviously can't do with the restrictions.
So there will be restrictions in that
policies,
sense. Dividend
all those things.
Good.
But all that stuff can be agreed. Because that's not to say that
is agreed by the time
you
come to me saying, give us a few bob for this.
Exactly.
Okay.
That's agreed during legals as a part of the process. So you would never be in a situation where post-investment you're sitting there kind of going, can I get a bigger salary? Or can I declare a dividend? Or do we all declare dividends?
Yeah, no, we've thought about that in advance.
All of those things are ironed out in advance.
Just on a slightly higher level thing, before we were recording, you and I were talking about participation levels in equity markets.
Yeah.
And the difference with what we talked about was the difference between the United States of America and Ireland. Yeah. Can you tell me just what you told me before we started recording on that in that regard?
It's like, look, I spend a bit of time in the States. I spend quite a bit of time in the Middle East because, look, my investing partner Fouad Khan is based in the Middle East. But it is interesting when you look at, I suppose, participation rates across the board. And it was at a talk recently. It was an ISIF event a couple of weeks ago, which was brilliant, in fairness. And they had Larry Fink talking, and it just by pure coincidence was the morning after the night before being Trump's tariffs.
Liberation Day.
Liberation Day, yeah. And look, clearly Larry was not there to talk about the tariffs, and he was right not to, right? But, he made a really interesting point that you would see, you could actually see in the States, you can see in the Middle East is what he called is kind of civilian participation, right? Which is people, where their capital, where their money sits. So, in the US, he gave a stat, and it was like, 60 to 65% of civilian participates in capital markets, any form of capital markets.
Be that public markets or private,
money market, all those different products.
Yes.
Because there's probably it's widely available. There's probably more awareness. There's probably more of it there, right, to access, and it's way more accessible. It was really interesting in Ireland is, it's sub 10%, and it's kind of in the 8 to 10%, and which there's two sides of that. Is one is there's a lack of participation, or maybe the way I look at it is there's probably a lack of route for people to participate, where they're happy to participate, where there's credibility to participate. And And then the flip is there's a lot of pent up money in bank accounts. So like, there's a reason the banks can behave the way they can behave. I'm not saying the banks are bad. It's just that there's a lot of money sitting there because there's very little alternative for it outside of, public markets with is widely served, pensions and others, because like what we're offering in Quintus is access to private market investment opportunities in equity as well as others. But my area is equity, and that's what I'll talk to. But that's not widely available here in Ireland.
No, but it's no coincidence either, Kevin, that United States of America, for all its foibles, and as you say, we won't get into the political issues that the US markets are dealing with, but it is the richest country in the world from a millionaire per capita basis. And it's probably no coincidence that it is when it's 65% participation in the markets. And it's probably no coincidence that we're not because of 8 to 10% participation in the markets. And I think that has to be drawn. I mean, the private, particularly you talk about private equity markets. The public equity market here is so small. It's a pimple on an elephant's backside in comparison to the global equity market, as it were. But I mean, that's what we hope these podcasts will help people identify, that there are alternatives, that there are. I think the last time I saw a number, I think somebody I was watching one of the current affairs programs, and I think the chap said there's 146 billion on deposit in Ireland.
We just want a fraction of that.
Yeah,
So
1% of that would do. But, that people, as you rightly say, and I think what's lacking is information.
Yeah, agreed.
And we go back to the United States, as I said to you in pre-recording, the simple fact is the United States has been a rich country for a long, long time.
Yeah, agreed.
Ireland has been a rich country, relatively speaking, for a very short time. And the people who have the wealth in Ireland haven't yet learned the lessons that those with the wealth in America learned over the last 100 years, that we've been trying to learn since the Celtic Tiger, probably, or maybe even, I think you said, even less in terms of time.
And I think that's important because and they're right because they're being prudent. So it's like if they don't have an alternative, it should sit in the bank. I mean, they shouldn't be looking for the wild and wacky.
But they also should recognise that the buying power. I was talking to somebody the other day and they were saying, well, I'm getting 3% a year. And I said, well, yeah, but you're getting 2% a year. Because dirt tax is 33%. So you're not getting 3% a year.
Plus bank charges.
You're getting 2% a year. And inflation figures on the radio this morning are 2% a year. So you haven't made anything.
Yeah.
This idea that you're making money when the bottom line figure at the end of the year is higher than the top line figure, that's not so.
Yeah.
And that's not so because of buying power. So there's a lot of people being fooled into thinking they're getting richer when they're actually getting poorer.
Yeah.
Because of that.
And I think it's important to look at, engage with an advisor, like yourself, Paul. But it's how you look at your diversity of wealth.
Yeah.
So it's like, spread a bit.
Absolutely,
and I think that's important.
Just to slightly correct you there, I don't consider myself an advisor. I consider myself an information provider at this stage. I used to be an advisor, but I think one of the problems too often in terms of the whole advisor space is that there, a lot of financial advisors out there are, selling pre-packaged product. That's from the high street rather. And you and I were talking before we were recording, and I was saying to you that, Ask About Wealth is aimed at a certain market. I mean, and I think you agreed with me when I said the average person out there is well catered for by the high street market. The super rich are well catered for by international tax consultants who have them living on a yacht in Bermuda with no tax residency at all or whatever.
Yeah.
But it's the people in the middle.
Yeah.
It's the Ireland's new wealthy, whether they're new wealthy through income or new wealthy through capital, that is not being well catered for by the average, the high street, nor by the super rich. And I think, that's where we're trying to give that information and say to people, and hence bringing people like you to the podcast to say there is an alternative out there. It may be a little more difficult to find than the high street.
Yeah.
But they are there, and they are open to discussion.
Yeah. And what I would say is, like, even just people curious. Like, obviously I've mentioned levels in the sense of, like, people that would consider 500,000 to invest in an equity deal. Like, we're here, like, do talk to us, because it's,
costs nothing to talk.
Nothing to talk. And we're here, like, Quintus has been around for a long time and is going to be here for a long time more. So that's very important. Start dialogue, start to understand. No, there's no expectation that you're going to write a check this year or next year, whatever. Just understand.
Yeah.
Educate yourself. And
information. Get the information.
See how it develops and start to question more. But look, that builds relationships. You know that yourself. So
absolutely.
That's I think is investments.
So it costs nothing to get in touch. It costs nothing to learn.
Exactly.
And, it may lead to something, it may not. I'll ask you the rudest question as the final question, if I may, Kevin, which is, how do you get paid? And I mean, not you personally, Kevin, obviously, but how do Quintus get paid for this? I mean, you're not a charitable institution, I presume.
No, absolutely not.
So
we obviously have to get paid in the sense of you, like any business, you have to value what you do, and I value that highly. Without being. That is not an arrogant statement. I mean, people sell products and premium products for a reason, and I would consider what we do a premium product and service if that's what we wanted to put it as. So the way we get paid is we charge what's called a placement fee on the investment on the way in. So that is for completing the deal, our team completing the deal, managing the due diligence process and completion, because it has to be managed by Quintus Capital. The interesting thing is we don't charge the investor a fee throughout the journey, which is important, because we're not, once the placement fee has been...
So there's no annual management fee?
No.
Okay.
Now, we do charge the company a management fee because we are working with the company, and that is important to state. But we also have what's called a carried interest. And that is also...
So there's a success fee.
Just a success fee. That is not an exit fee. And that's important. So we do not charge an exit fee. It's a percentage fee on the uplift over a hurdle. Again, I'm not going to go into too much science.
No, I don't need you to.
But there's a percentage uplift, because what that does is it allows us to work hard to get the best results.
It does. Well, there's an alignment of goal. I often say to people, never worry about what the other fella's getting.
Yeah.
If you're happy with what you're getting yourself, number one. And the second thing is make sure the goals are aligned.
Yeah.
Make sure what's good in this case for Quintus is good for the investor. What's bad for Quintus is bad for the investor. And if you can get that alignment of goal, then, as I say, fees become irrelevant.
But it's an important conversation, because
it is. But
you're right to ask, because it is something like we will always get out front.
So your placement fee, does that change project by project?
It will.
Okay. So it would be declared to somebody as part of your process. Okay. Yeah. And the success fee changes project by project?
Typically be fairly often, will more than likely be the same.
Okay.
So it's a 20%, it's called a 20% carried interest over the 10% IRR.
Okay.
I'm not going to go into IRRs if you want to.
So
we don't
get once the IRR exceeds 10%, you're into profit making you're into profit sharing in that case.
Exactly.
Okay. So
You're creating hurdles, and that's important.
No, absolutely, and you know, measurable hurdles, which is important.
Again, alignment is so important, and clarity is so important when it comes to investing.
Well, I mean,
investing
that's
can be
often
quite murky,
Yeah,
as
no,
you know
it
yourself.
can. And the problem with, again, you know, the high street at times is that, you know, what's good for the investment manager may not be good for the investor, and vice versa. So, Kevin, I said that would be my last question. I'll keep my word. It just remains for me to thank you for coming in today. I'm delighted to have met you.
Thank you, Paul.
I will ask you, if anybody listening wants to get in contact with you, how do they do that?
They can contact me via the website. My email address is up there.
Okay. And the website is what?
quintuscapital.ie. And then my email address is Kevin Mac, MAC, at quintuscapital.ie. Kevin Canning got the Kevin before me. So,
okay.
Kevin Mac at quintuscapital.ie.
Well, Kevin Mac, thanks again for coming in today. I've been delighted to have you here.
Pleasure, Paul. Thank you.